Where are the top 5 property hotspots for UK buy-to-let investment? In this video, I'm going to share with you the 5 places in the UK where you have maximum rental demand, the 5 places where you get maximum capital growth, and I'm going to share with you a strategy of how to capitalize when investing in hotspots. It's a strategy that's worked very well for me over the years, and it's one I normally share with my mastermind group, so stay tuned for more. Hi, I'm Ranjan Bhattacharya. I've been a property investor and developer for 30 years. You may have seen me on the hit Sky TV show Property Elevator, or you may have attended one of our Central London property meets. If it's the first time you're here, then make sure you subscribe and hit that bell icon, because we release new content each week and it's all dedicated to helping you keep on top of your property investing game. So a lot of people who are getting into buy to let think about hotspots. Where are they? What are they? Well, in this video, I'm going to tell you the top 5 in terms of capital growth, in terms of rental demand, and also the strategy to take full advantage. Let's face it, buy-to-let has taken a little bit of a beating in recent years. In 2016, there was the introduction of the Section 24 tax on mortgage interest. And I've done some videos on this, and I'll put a link in the description below. Also in 2016, there was the introduction of the 3% SDLT, that's the stamp duty and land tax surcharge on buy-to-let investment property, which also basically increased the upfront cost when you invest in buy-to-let. And what that meant was, in the years up to 2019, there was a 40% fall off in the amount of buy-to-lets purchased by property investors. Of course, there were massive regional variations. In London and the southeast, or in areas where house prices were expensive, rental yields were lower, and those areas saw the most tail off in buy-to-let investor demand. But on the other hand, in the north of England, in the Midlands, where house prices were lower, rental yields were higher, and they saw less of a fall off in buy-to-let investor activity. And of course, the 3% SDLT surcharge also added to this quite a lot, because remember, you can't borrow, you can't get a mortgage to pay stamp duty. You have to have real cash to stump up to pay the SDLT. So in cheaper areas, the effect of the 3% surcharge is less than in higher areas, which means you need less upfront cash to invest in buy-to-let in the cheaper areas, which has fueled their growth. Now, bringing this all forward to today, we now have the reintroduction of the 80% buy-to-let mortgage. And figures from the Nationwide Building Society show that in the latter half of 2020, 37,000 buy-to-let mortgages were granted in the UK. So where's everyone buying for buy-to-let? Well, look at the name, buy-to-let. You're buying to let. So we first have to look at the letting demand, the rental demand. So I'm going to first talk about where are the areas of maximum rental demand in the UK, and they vary massively from region to region. The other key word in the phrase buy to let is the word buy, and the reason you buy is essentially for long-term capital appreciation. Of course, you buy for cash flow as well. Cash flow essentially pays the bills. It pays the bills of servicing the debt and maintaining the property, gives you a little bit of a surplus, you can achieve financial freedom and all that sort of jazz. But the big secret, in property investing is that wealth generation actually comes from capital appreciation. And do you really want to buy to let? Not just in areas where you can rent the things out, make a bit of positive cash flow, but in areas where you're going to get and benefit from that long-term capital appreciation, because that's what builds wealth. So let's look at rental demand across the country. I've got a graph for you which basically shows the demand to supply ratio. And this is basically for the period of the last year. Now we can see that London, inner London in particular, has basically been absolutely clobbered. And this is basically because of the COVID-19 crisis. No one wanted to go on the tube. People didn't get into work in the centre of town. Offices in the centre of town were closed. So people didn't need to rent property in the outer London zones and commute to work. And therefore rental demand fell, rents have fallen, and basically London and the southeast has been hammered. The interesting thing to draw out is the way they have actually done a column for the whole of the UK, excluding London. Excluding London, the picture really is quite different elsewhere. So if you're investing in buy-to-let, you do have to look where there's strong rental demand. Oh, by the way, if you're getting value from this video, make sure you smash that like button. It means more property investors get to see this video. So where are the property market hotspots in the UK? Well, figures from the Office of National Statistics show that for the year up to March 2021, we've had an 8.6% growth in house prices for that year over the whole country. And in the month of February 2021, we saw the fastest monthly growth in UK house prices since October 2014. So here's some stats from Land Registry, again for the 12 months up to February 2021. You can see regionally where house prices have really gone up the most. The northwest of England seeing rises of 11.9%. But by the way, the smart money is getting back into London right now because that is a very, very sensible place for a rapid recovery. But that's a subject for another video, so make sure you subscribe and hit the bell icon so you're notified when that gets uploaded. Now obviously when investing in property you can't just jump on the bandwagon. You've got to look at the prospects for continued growth over the next 10 years. So the fundamentals need to be there. We'll get back to the video in just a moment, but what I wanted to really tell you about was what is the most exciting opportunity in property right now, and that is repurposing defunct commercial buildings to residential use. Now, most people don't really know where to start, what to look for, and how to exploit these opportunities, and that's why I've prepared 90 minutes of free training for you to get you started on this wonderful journey. You can register for this free training at property-workshop.com. Join me on that free training, and I'll leave you to enjoy the rest of the video. Thanks to the government's levelling up agenda and also this desire to break the red wall and turn it into a blue wall, we're expecting to see a lot of government policy basically encouraging growth in the northern parts of England. And of course, in a previous video, I've talked about the government's new 95% mortgage for first-time buyers, which is going to be big. But basically, the 95% mortgage is structured in a way that will benefit buyers from northern areas much more than it will do for London and the southeast. It'll benefit people who are buying lower value properties because basically the affordability of a 95% mortgage is there, whereas the salary levels aren't enough to qualify for a 95% mortgage on a more expensive home in the southeast. So there are a lot of things in play right now, which I believe will ensure that the growth in the northern regions is not going to be short-lived and will continue. So which towns in particular are leading the charge in terms of house price growth? It pains me to say that none of these towns are in the M25 area. So at number 5 in the UK, we've got Liverpool with a 6.4% growth, Wakefield at 6.5% annual house price growth, Wolverhampton at 6.8%, Bolton at 7.5%, and the number one place which got the most house price growth in the UK last year was Oldham at 8%. So how do you profit from this sort of hotspot data? Well, the data I've shared with you is published data. I mean, they're from places like Zoopla, the FT, Office of National Statistics, and Land Registry. So once these sort of statistics have all been published, isn't it too late to dive into those hotspots? Well, not quite. There is a way to capitalise on hotspot information and basically not miss out. If you're getting value from this video, smash that like button. It means more property entrepreneurs like you will see this video. Now, this is a strategy I've been using for many, many years, and it's normally something I share with my mastermind group. So listen up. So when you read about hotspots and you're wondering whether it's too late to dive in, it's not too late to dive in. The area to dive in on is commercial property in those hotspots locations. Now, to set the scene for this strategy, let me share with you 3 facts about commercial property. Fact number 1. Residential properties are valued based on a bricks and mortar basis, on comparables. Commercial property is solely valued based on the rental income that it generates. Fact number 2. Commercial leases are often 5, 10, 15 years or even longer. What that means is the rent that a commercial property is generating was often set several years ago. Fact number 3. Commercial property values always lag behind residential property values. And that's simply because when you've got long commercial leases with rent reviews only every 5 years, the rent that's currently being charged on that property is often out of step. And because the value of that commercial property is determined by the rent roll, the value of that commercial property is often undervalued. And of course, thanks to COVID-19 and changing ways of doing business, we have a massive oversupply of commercial properties. Be they shops, be they offices, they're all in massive oversupply. And remember I said that commercial property values are largely driven by the rent roll. How do you value a commercial property when it's empty? So what we find in hotspots areas is that residential properties per square foot are rising, and they're up there. And you've got these commercial values for the same square footage of space, but just because it's designated commercial, those values per square foot are much, much lower. But now, of course, we have permitted development rights. The brand new permitted development rights the government have introduced allow you to convert commercial buildings to residential space with light touch planning permission. In other words, it's relatively simple. So if you want to profit from a hotspot, don't look at the residential, look at commercial space in that hotspot area. Look at learning all about the permitted development rights that are out there, which allow you to repurpose those commercial spaces into residential. That way you not just uplift the value, you change the property you move it from the commercial track, which has a predetermined way of valuing that real estate asset, and you shift it to another track, which is the residential track, where the method of valuation is completely different. Now that in the nutshell is the number one way to profit by investing in property in a hotspot location. Now obviously there's a lot more to it than that, and I've only spent a little bit of time touching the surface of this, but I've got a free 90-minute masterclass on this, which I'm going to deliver live to you guys. You can register for free. The details are down on the screen here, and there's a link in the description below. So join me for 90 minutes and I'll share with you exactly how you can use permitted development rights to easily repurpose commercial buildings, which are now defunct, to residential use, and also how this can really maximize or 10x your profits when applying these in hotspot locations. That's it for me. Join me in the next video. And the number one place which got the most house price growth in the UK last year was Oldham at 8%. Where the hell is Oldham? It's a dump.